The UK is introducing significant inheritance tax changes, shifting the focus from domicile to residency. These new rules will impact how non-DOMs are taxed on their global assets, making it crucial to understand and adapt to the changes ahead. Let's have a quick look at what these changes will mean for you. From the 6th of April, 2025, the UK will introduce major changes to its inheritance tax, IHT system. These reforms shift the focus from domicile to residency, impacting non-UK domiciled individuals significantly. Understanding these changes is crucial to avoid unexpected tax bills. What's changing? Inheritance tax will now be based on residency, not domicile. The remittance basis is ending. Non-DOMs will be taxed on worldwide income. A tail provision extends IHT liability for former residents based on their time in the UK. If you're planning to stay in the UK for 10 years or longer, or have already lived here for that time, you need to reassess your tax strategies. The rules now impact global assets and could have long-term effects even after you leave the UK. Former residents may still owe UK inheritance tax on global assets for up to 10 years after leaving the UK. This depends on the duration of prior residency. Longer UK residency means a longer period of IHT liability. From April 2025, anyone who has been UK tax resident for 10 of the last 20 years will be classed as a long-term resident. This means their worldwide estate will be subject to UK inheritance tax. The longer you have lived in the UK, the longer your assets may remain taxable, even after leaving. Non-UK assets will be exempt from UK inheritance tax for the first 10 years of residency. After this, all worldwide assets will be taxed at 40%. Even if you leave the UK, your non-UK assets may remain taxable for years depending on your residency history. From 2025, trust tax liabilities will depend on the settler's residency at the time of death or other chargeable events. This means many trusts will lose existing protections and may require restructuring to avoid significant tax bills. Transitional measures allow some relief. The temporary repatriation facility lets you bring untaxed foreign income into the UK at a lower tax rate. You can also rebase certain non-UK assets to their 2017 value, which may reduce future capital gains tax. Let's look at the impacts through real-life examples. Take Ted from Australia. If he passes away before April 2025, his estate pays inheritance tax only on his UK property, totaling £190,000. However, if he survives until after the new rules come into effect, his global estate, including Australian assets, will be taxed, increasing the inheritance tax bill to £3.9 million. Another example is Nico from New Zealand. He plans to leave the UK in 2025 and return to New Zealand. However, under the new rules, his worldwide assets remain subject to UK inheritance tax for up to 10 years. When he dies in 2034, his estate's value has risen to £8 million. Despite living outside the UK for nearly a decade, his estate must pay 40% UK inheritance tax, reducing the amount left for his children by £3 million. What should you do? Plan early. Use the 10-year exemption to restructure global assets. Seek advice. Work with tax advisors to manage trusts and estates. Understand tail provisions. Be aware of how long UK tax rules apply after you leave. The UK's inheritance tax changes are a game changer for non-DOMs. By understanding the new rules and planning effectively, you can protect your global assets and reduce your tax liabilities. Take action now to safeguard your financial future. Take the time now to review your situation and ensure you're prepared for the road ahead. With the right strategy, you can minimize tax burdens and provide peace of mind for you and your family. And remember, No Worries is always here to help you navigate complex tax landscapes with ease and confidence.